Hi everyone, welcome back to my third installment of Mish's Market Minute. I'm your host, Mish Schneider. Thank you so much for joining us. And again, thank you to the StockCharts team. I've got a lot to cover today, so I want to get immediately started. What I did was almost like a college thesis paper in trying to find the comparisons between 1973 to 1982 and most specifically 1973 to 1975 versus the years of 2019 and 2021. I look at the similarities and the differences from growth to recession to stagflation to hyperinflation. And we'll look at oil, gold, bonds, the Dow Jones Industrial Index, how government spending was, the dollar, the GDP, employment in agriculture during that time compared to now. And if we have time at the end, we will go through a quick update on the four indices. So let's begin. So why even focus on the period of 1973 to 1975 and beyond? We're going to start with a look at the Dow Jones Industrial Average in oil, but I just want to mention that the reason why I got interested in this was because many people, economists, have been calling the recent market activity similar to the Great Depression of the 1930s, and clearly there have been some comparisons. But what barely existed in the 1930s was this level of quantitative easing. In 1932, there was some congressional support that allowed the Fed to purchase approximately $1 billion in Treasury securities. But now, of course, the Fed has brought up debt to an unprecedented level, and the government is spending trillions on stimulus. So a depression is not necessarily out of the question, but I see this better comparison to the mid-70s. So let's go ahead now and look at some charts. So the first chart you're looking at here is the Dow Jones Industrial Average going back from the 1900s all the way to the present time. And you can see where here in 1932, during the Depression, there was a nadir that hit. And then, of course, the market and the economy came roaring back. From 1954, right here, when the pre-Depression highs were taken out, until 1970, right here, you can see that the economy was doing very, very well. This was a big growth period in the United States. And it enjoyed a run in the Dow Jones Industrial Average from 200 all the way up to about 1,000. And then we started to hit that first crisis in 1972. We had the Yom Kippur Wars. And from there came the oil embargo when OPEC was formed and they tripled the oil prices. Those of you who were alive at the time could remember the gas lines that were literally around the corner to try to fill up your tank, and the oil prices spiked, and we will look at a chart of that. But now we have a very different type of oil crisis. We have just the opposite. We have very low demand and a tremendous oversupply. And we're going to talk about that more and look at the charts and show how that could be comparable down the road. So when the Dow Jones Industrial went from its peak in 1971 to 1972 at 1,000, as you can see here, it then, during that recessionary period, almost fell by 50% down to $570. Then that was in 1974. It took nearly 10 years for the Dow Jones Industrial to come back through that 1,000. And then, of course, once it did, you can see that it hasn't looked back, except for a couple of corrections along the way. So this here now is a chart of the oil. And this chart of the oil is Brent crude oil. And in 1972, we had, this is here what you can see reflected is in the actual oil crisis that happened. It started out, though, at around $22 a barrel. It spiked to about $58 a barrel in 1975. And by 1979, when we were in the throes of the inflationary period that went out of control, it started to climb and then finally peaked in 1980 at $117.30. So the inflation was out of control, and a lot of this also had to do, of course, with that geopolitical stress. Then in 1990, we found another peak after we had the Persian Gulf War. But the one after 2008 really has my interest here. In 2008, right before the crash, oil actually peaked at $160. Then it crashed in 2009 all the way down to $64. Then by 2010, it went back up to 84, and then it peaked again here in 2011 at about $125. Right now, what you can see is it's all the way back down here, really close to those 1972 lows. So what this suggests is that once the stimulus really hits the market and the recession starts to come to an end, we could see a real big demand for oil rising. Since 2014, even with the economic expansion, well, although that's questionable in terms of the word expansion, oil has really dropped since then. So it's no surprise that we see these kind of prices now with the demand being almost zero. So what happens once that demand returns? And also another question we really have to ask, thinking about what happened here, is every time we've hit this price, in this case it was World War II, in this case it was the oil embargo, in this case it was the Persian Gulf War, in this case it was just an expansion here, and also we also had the Gulf War during that time. Since then, we have to ask, what would make the oil go up besides a rising demand? Could there also be a risk of any kind of war? And one story that has been circulating in the last couple of days is that in the last 2 days, armed Iranians have seized and then released 2 ships near the Strait of Hormuz. One was a United States ship and the other one was Chinese. So that's just something to think about. Every time oil has gotten down to this price, something has happened to raise those oil prices. Now, the next thing I want to explore here is when oil spiked and the market lost ground, what happened to bonds, government spending, employment numbers, and the gross domestic product. So here now you have a chart of the 30-year T-bill, 2 bonds, and by the way, all these charts are complements of StockCharts, up until from 1942 to the present. So after the low rates that you see here in the 1940s to 1950s, rates began to rise with an improving economy. The box that I have highlighted here is what rates spiked in 1970, right at the start of the inflationary period here that you can see. And then it fell during the recessionary period. Why? Because the Fed actually came in and lowered the rates. So now what happened after that was, as commodity prices were starting to fly and oil prices were starting to fly, rates started to rise. And the Fed came in and started to go crazy trying to control that inflation. So you can see the peak prices up here in 1981 to 82. That was up at 20.5%, by the way, is where the interest rates went at that particular point. So since then now, if we go down to today, we have fallen to zero. In 2008, when QE began, there was room for the Fed to raise and to lower. But now what happens from here? Does it go negative from here? To me, this spells that there's really only one direction for rates on the longer term, and that would be up. So that's something that we need to keep an eye on as well. The next chart here is of government spending. And I found this one to be extremely interesting. Again, if we go back to 1970, you can see right during that recessionary period, government spending went up. And that was mainly because what was also going on during that time was the Vietnam War. So the government was spending a tremendous amount of money on the war. So on top of a falling stock market, a recession, and rising oil prices, government spending increased. Now notice that it increased again, if we go up to 2008, getting to 2008, right when QE started to happen. Now, here we are right here, and what's very interesting about this chart is what we cannot see is where government spending is right now. Because of the virus, although it's not exactly a war, but still a crisis, the government has spent in excess of $6 trillion, plus another trillion could be on tap in May. So I tried to find projections for the following year, but clearly we are all the way up here off the charts. Nothing exists at this point. Sorry, just switched charts accidentally. Nothing exists at this point because of the fact that nothing has been made in terms of the government spending based on what's happening over the last month. Okay, so now if we move on here, this is also extremely interesting to look at that time and now. This is about unemployment. So there's another theory that goes around that you can have inflation without a high employment rate. Well, that's not necessarily true. If you go to the mid-70s here, you can see that the unemployment started to rise. By late 1975, which is up here, it spiked to over 9%. And by the height of inflation, the period here, all the way up to 1981, it rose to about 11%. So now again, if we come back to here, in the current crisis right now, unemployment is projected to be all the way up beyond this box, up at around 14%. So the takeaway is that unemployment and recession are linked, but inflation, which peaked in 1981, also saw a very high rate of unemployment, even though the prices had flown up in goods. Okay, now the next thing I want to show you is GDP. So first of all, let's review a little bit about what gross domestic product even means. Gross domestic product measures the value of economic activity in a country. So it's the sum of the market values or prices of all the final goods and services that are produced in an economy during a period of time. And of course, we look at it on a quarterly basis. So the GDP is a number that expresses the worth of the output of a country in the local currency. So note that in 1970, if we go up here, in 1970, you can see that gross domestic product, when the recession hit, fell. Then in 1972, stagflation hit, and actually it turned out to be good for the gross domestic product, rising up to 5.3%. Also, we had the end of the gold standard during that time. And just to remind people that might be too young to remember, the gold standard was a monetary system where a country's currency or paper money had a direct value linked to gold. So the countries basically with the gold standard agreed to convert their paper money into a fixed amount of gold. And the reason why that happened back then was that the gold supply, which grows very slowly, would actually theoretically hold the government back from overspending and keep inflation in check. But of course, you can see that went away. And when it abandoned it initially in 1933, but then completely severed the link between gold and the dollar in 1971, hence setting up the stage for stagflation. So then the Fed in 1976 lowered the rates, as you can see here. And that was to spur the economy. But instead, it was the start of inflation going nuts. And then the Fed, of course, had to do the reverse when Volcker raised the rates to over 20%. GDP fell again in 1980-81 when taxes were increased in 83. Once again, we started to see GDP rise. So now if we go on to the next view, a more present time, you can see here that in 2000, since 2000, actually 1999, the GDP has continued to fall. If we go down to 2018, it started to rise again. But even after almost 10 years of a rising stock market, all the economy could do was grow by 2.9%. So now for 2020, the expectations for GDP are to go under 2%, and that was before the virus. So in 74-75, the GDP was negative. When inflation began, the GDP initially rose, then it fell in 1982. During the height of inflation, and then began to rise again. So GDP will rise in the face of inflation until inflation goes out of control. Okay, so now let's take a look at what about gold, the dollar, and agricultural prices during that particular time. This is the gold spot price. So you can, again, during the boxed area here in the 70s, it rose right into that stagflationary period. And then this was the dip after the Fed announced that it was going to lower rates. But after that, on its own accord, because of inflationary environment, partially due to the oil, but the oil crisis was basically over at this point, this really started to go ballistic. And in 1980, it went from $125 an ounce to $850 an ounce. Now, if we move all the way over here to 2008, when QE started, gold once again went crazy, taking out that $850 and going all the way up to a peak right around $1,800 in 2012. So now here we are in current times. The rates are basically zero to negative. If history has anything to say about it, we can exceed the highs not only from 2012, but maybe go to $2,000 an ounce. And also, if you look at the basing action here, between 2012 and 2018, really this was in a range and consolidated, which is another reason why we're seeing the type of movement that we're seeing right now. Now, this here is the US dollar. The dollar is another interesting comparison to then and to now. In 1970, so right here, the chart really actually starts a little bit later than that, but in 1970, it rose to about $1.10 against the euro, that is, falling back, although the euro didn't exist back then, but essentially you have to have some point of comparison. And then it fell back in 1978, right after the stimulus happened. So when the Fed started raising rates, once again, to control inflation, the dollar peaked out in 1983 at 160. So the dollar rose basically to take advantage of our high interest rates. So now let's go to 2008, right here, fast forward to 2008. The stimulus helped it climb out of the doldrums because obviously the dollar was getting destroyed during the first part of the downturn. And so with the Fed coming in, it actually did the opposite. Rates went up, but the dollar got more attractive because our economy started to improve. So then basically in 2017, if we go fast forward from there, it peaked out at around 102. Now, even with the stimulus that we have, the dollar is still very strong, but there's a very big difference reason why now as opposed to what we saw in 1983. And that is obviously because foreign countries are still buying our dollar. Now, there's a lot of talk about that. There have been analysts who have forecasted that China actually may reduce our Treasury holdings as there is an uncertainty regarding the US dollar as a global currency following this massive QE. So basically what China is saying is they had been increasing their US Treasury bonds holdings as of February, which was only the second time it had risen in a year. And foreign holdings in general of Treasury bonds have hit a record high of 7 trillion in this month, with Japan being the largest holder. However, people in China and the analysts in China really still feel that Beijing may continue not only to trim the US Treasury bonds in the coming months, but that because of the Federal Reserve's QE program, along with the recession in the US that's coming, it will further depreciate the greenback. And also one other note is that China, India, and Russia have been in meetings for a while now, trying to figure out how to go around the US with talks of replacing the dollar as the world's reserve currency. Now, the obvious question would be like, what would they replace it with? So there may not be any imminent threat to that, but I wouldn't dismiss that notion altogether. Because in the meantime, these foreign countries that are buying dollars, the dollar becomes the wild card in the future of producer prices, inflation. And as you can see historically, the dollar should be way lower when the Fed does the level of massive QE it has done recently. So the percentage of our total national debt versus GDP has increased exponentially. And this is the best case of why the US is at threat as losing its status as the world currency. So that's a pretty frightening thought right there. Now here, this is a chart of the agricultural raw materials. And again, if we take a look back in time, the chart starts at 1970 here. The prices fell from the peak in the 1980s and then started to rise. And then here we are in the 2000 recession. You can see it peaked up here when the economy was doing very well. The prices started to fall again and then rose all the way until we got to 2008, dropped. And again, after QE, look at the incredible price increase in these raw materials in the agriculturals. And so there was no talk of inflation at the time, which though is very interesting. I mean, this followed on the heels of gold, et cetera. But at that point, things seemed to be much more in control. And the dollar, as we saw, wasn't nearly as low as it was during the period of time when we started to see inflation. So this is what we're going to be watching for now. Here we are with agricultural prices near all-time, not all-time lows, but near historical lows over the last 10 years. Remember last week I showed you a chart of DBA. But what could happen now, and this again, related to the dollar, but also related to the pandemic, is that food hoarding might start to begin. That's where I think you will see inflation, if it starts to come, really appear. The governments are starting to get more serious about securing their supplies of key staples. for example, the grains. There have been export restrictions and plans to hoard more. There are signs that the typical trade routes are being affected as the season nears an end. And the market also can't really afford any weather-related incidences. And right now we are right in the heart of the growth season as we're into the spring. Stockpiles are already declining and there has been drought. The European Union, Russia, Romania, they've put limits on their trade and exports, and Egypt plans to buy about 800,000 tons of wheat while there is a weather risk. So with lots of wheat around, the hoarding still has begun with supply chain issues and now a dicey dry spring season predicted. So there's another wild card for you. Now let's take a look quickly at consumer price index, because this is also an interesting chart. So this measures the weighted average of the prices of consumer goods and services like transportation, food, medical care, and it's calculated by taking the price changes for each item in this sort of basket of goods and then giving them an average. So this is also really tied into the cost of living, and also one of the most frequently used statistics for identifying periods of inflation and deflation. So you can see since 2020, we have dropped here. This little window is a magnification of just the last year. But up until that point, here we are in the 70s, consumer price index, when you see about the cost of goods not being so expensive, you certainly don't see that reflected here. Only now are we seeing a drop, and that's obviously because of the virus. But the metrics definitely do not agree with what you see here. The disparity is very interesting. And some of it has to do with lower production costs, automation, some alternative growing conditions for plants with hydroponics, GMOs. But what we could see, besides the fact that we're seeing an impact now in consumer goods and services, is that once we get back to work, there could be a huge boost in prices. And historically, we have seen that even though the jobs rate may stay high, the inflation rate and high unemployment does not necessarily have to line up. Now let's take a look here at, just want to make sure I didn't miss anything here, what we can look for in 2020 to 2021. I'm sorry, I'm having a little trouble here with my slides. Okay, here we go. So, looking at oil, remember we looked at it. Can it rise? That historical low there at $20 a barrel, something has happened always at that level over the last 50 years that has made that price go up. Gold looks like it's about to explode. Unemployment, as we can see, is not necessarily the big factor to control inflation. We're going to have a hoarding situation and rising consumer goods demand. The raw materials that are now starting to being hoarded by foreign countries, along with a declining GDP. So what have we learned from the 1970s is that word, once again, stagflation. After we heal from this particular period of time, which could only be months, and you can see the market looking forward is expecting that to go away over the next 6 months or so, the scarcity of goods that we're having because of the supply chain disruption, the low labor force, could actually be the thing that makes this look like 1975 to 1982, which is inflation out of control, with the rates near zero and the dollar potentially depreciating. So that is something to look for as we go into the rest of this year and into 2024. Okay, so now what I'd like to do is take a last look here at the current situation. So that's my theory, by the way, my thesis on the comparison of 73 to 75 into 1983 and this period of time now. Don't get lulled into complacency, because I do believe that we're heading in that direction. And certainly, since it's been 40 years since that's happened, it's got a very high probability. And one thing I didn't mention, by the way, is that commodities in general is at a historical low ratio to equity. So all of this comes into place. Now, let's go and take a look here at the last look at 3 indices that took the blue pill and 1 index that has swallowed the red pill. And that now is looking at the 4 indices, the S&P 500, the NASDAQ, the IWM or the Russell 2000, and the Dow Jones Industrial. Now these numbers reflect the closing prices since the market has closed on Thursday things have rallied in the after hours. But nonetheless, what we need to look at right here is how the momentum compares to the actual price. So starting with the SPY, which closed at 278 on Thursday, even though it's trading higher on the aftermarket, on Friday, if it can take out the 50-day moving average at 287, what we also really need to see down here is the momentum start to increase and clear this first moving average. So even though we see a completely different picture in NASDAQ, the momentum in this actually has declined, even though the price has held steady. In the NASDAQ, what we have here is a bullish market, first of all, because you can see the price is above both the 50 and the 200, and that bullish phase has confirmed. And again, we're trading, actually, you know what? This chart right here should be up here. Whoops. It should be trading up here, up at 212 is where it closed, 212, 213. But nonetheless, the important thing right here is the momentum. So the momentum has cleared the first moving average, now has to get through this. So even though this rally is good, we want to make sure that the momentum lines up. Because very often what you see is a price go to a high and the momentum doesn't follow suit. And then what happens is things turn down. Not to mention that I've been writing, we're going back to the SPY here, that if we can get anywhere near 287 to 290, that could be the return to the moving averages that creates a short opportunity. Of course, that remains to be seen. Now look at the difference right here as we look at the IWM. The IWM here is, this is the 10-day moving average, is just barely holding on. Today it tested it and closed above it. But look at the momentum here. The momentum has been really weak and it declined even further as of Thursday. This is obviously the index that's taking the red pill while the others are taking the blue pill. And then of course, finally, we have the Dow Jones Industrial Average right here, which also closed up a little bit, but still very far from its 50-day moving average and also has declined in terms of momentum. So essentially what you really want to take a look at and see right now is that who's going to be right. The Russell 2000 as of Thursday closed down 0.86%, while the semiconductors, for example, closed up 2.71%. The regional banks closed down by 3.68%, and the retail sector closed down by 0.51%. So we know that in the last several years that NASDAQ, tech, and S&P 500 stocks have gone to new all-time highs because of the low interest rates and because of the low taxes. But today we've got the Fed and the insider buying, where the U.S. inside of the market still reflects the issues had before the virus and continues to do so. So now we have to figure out who is going to be right. Essentially, what we want to see right now is whether the virus or some cataclysmic event that we would have expected to happen turns out to be the great equalizer, and this rally that we're seeing right now is another blip like we saw in the beginning of 2020 when SPY and Qs went to new highs while IWM couldn't even get to the 2018 high. So we need to see the regional banks, the Russells, the retail, and the transportation join into this little fantasy island party. Otherwise, until that happens, you can enjoy the ride in the NASDAQ and the SPY, look for the resistance levels, but bulls do not get too complacent. Okay, that's it for now. I hope you enjoyed the comparison to the 70s to now. I'm still looking for that stagflationary environment to inflation. And of course, right now with the disparity in the overall market, looking to see whether the NASDAQ and the SPY fail or whether we can see IWM and the Modern Family catch up. Thanks so much for watching, and bye for now.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.